So you're going to have this kind of slowdown in the economy. Gold, silver comes in, maybe hiking of interest rates, which also causes the metals to usually sell off, but it's not going to last for long. So I would say look to accumulate. Yes, expect resistance at 20 on the way back up. But after some consolidation, I think it actually breaks through, goes to 30 and even 40 and 50 down the line.
This week's specials with Miles Franklin Precious Metal Investments. 1 ounce 2021 Silver Britannias for only $3.75 over spot. 2021 Silver Austrian Philharmonics for only $3.95 over spot. And 2021 Silver Australian Kangaroos for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today, our good friend Gareth Soloway from InTheMoneyStocks.com. Gareth, thank you so much for joining us today.
Oh, thanks for having me. It's always fun to come back.
It's great to have you. And I'd really first like to discuss the silver market because we've seen quite a drop in the last few weeks. Your perspective, where we are today, did we fall through critical support? Really, if we just look at the chart, where are we?
So on the chart on silver, you definitely are at support. So it did break a key support level and then collapsed into another support level. This is kind of an interesting market. On the previous times I've talked about how gold, I'm much more bullish because you have that kind of safety trade when the market gets into trouble, because whether it's the economy or something else, people are going to run into that safety trade. The issue with silver continues to be that it's an industrial metal in addition to a safety trade. So you don't get that same full effect of the safety trade, which is why I like gold and why I like Bitcoin in the longer term, even if in the shorter term, I think it's still going to have a little bit more downside. So silver is at key support, but I want to be clear, I still think it could go a little bit lower here. We could see it heading down on the SLV to about 18 and a quarter or so, which is still significantly lower over the next couple months.
No, the SLV is normally about $1 or so lower than the spot price. So that would be around $19 or $20 for the spot price.
Yeah, I think on spot price, you start to really slowly accumulate at anything below 20 and then just kind of slowly accumulate on the downside. So I wouldn't necessarily jump all in, just on the second it pierces 20, but just start to take small positions. Maybe, factor in something like, do a 1/6 position at 20 Pierce, a 1/6 at 1950 Pierce, and then leg in that way. I've always found that that's more successful in trying to, you're not, even me, and I've done this for 20 years, to pick the exact low on anything is almost impossible. So what I do now is I kind of say, okay, I'm going to invest X amount of dollars in silver. I'm going to buy this much percentage of that total each level as it gets down.
I know if we break below 20, that is breaking below, the key 21 support level. Do you see it having an issue then getting back above that?
That's a good question. I think it will struggle a little bit when it gets back to that level, but inevitably longer term, I still have this viewpoint that the Fed is talking more hawkishly. I'm sure we'll talk about that in a minute. They're going to taper, but we all know that the Fed is in a box now where they can only do so much before they have to loosen monetary policy again to combat the next crisis, right? So you're going to have this kind of slowdown in the economy. Gold, silver comes in, maybe hiking of interest rates, which also causes the metals to usually sell off, but it's not going to last for long. So I would say look to accumulate. Yes, expect resistance at 20 on the way back up. But after some consolidation, I think it actually breaks through, goes to 30 and even 40 and 50 down the line.
So this really presents an interesting opportunity if we do see, even at today's levels, silver being pretty low compared to where you see it going. But if we do see this fall, it's a pretty good buying opportunity, it seems like.
Yes, absolutely. I think as an investor, you look at asset classes, whether it's stocks or commodities or different things, and you have to kind of have a shorter term view where it's going to go in the near term. And that's my swing trade, where I'm buying or selling for a week or two or a month or two. And then you have to have that long term view on where it's going to ultimately head. And I think same thing with gold, silver, and most other commodities. The global central banks out there, there's so much debt in the system, they can't have interest rates go up too much. So yes, interest rates will go up a little bit, but there'll be a point where interest rates going up then create a new crisis, which will then force them to drop the interest rates and print more money, pay off the debt via dilution of dollars and other currencies. So longer term, if you said to me, oh, I'm a 10-year, 20-year horizon person, I would say don't even worry about the price right now on silver. I'm just more of a fine-tuned trader where I try to get near the lows at least.
And speaking of what the Fed is going to do, we're going to hear the minutes from the meeting on Wednesday. But your perspective, because it seems like they are moving towards possibly tapering in September, and even mid-2020, I'm hearing, in mid-2022, I'm hearing, completely ending the bond buying program. So your perspective on what the Fed is going to do and how that's going to impact things.
Yeah, so I think the Fed is starting. So this is such an interesting thing, right? So months ago, we heard, oh, this inflation is 100% transitory, no big deal. And now, we've heard Powell and even Janet Yellen, who's not the Fed anymore, but kind of is. She's now saying, well, inflation's getting a little bit more concerning. We don't know if it's 100% transitory, as is the Fed. And now, to be honest, it seems like they're starting to come to the realization, which is what I've said and many others have said, that inflation is not going to be transitory. Now, it doesn't mean we're going to be at 8% or 10% inflation every single year, but the idea that it's going to go back to 2% is insane. And just to one of the little caveats here is, think about the labor market, right? So you have people that they're not going back to work for less than $20 an hour, even at the McDonald's of the world. And that is the biggest input cost to pretty much any business. So if you have the biggest input cost jumping that amount, the business won't pass it along day one to the consumer, but they will over time pass those costs on. And that's going to keep inflation kind of at a higher level for an extended amount of time. And that puts the Fed in a very tricky spot, right? Now they have to say, okay, well, we're not going to go back to 2%. So we need to figure out how to kind of curtail this inflation. But the problem is, if they raise interest rates too much and if they cut back on their bond buying too much, they're going to create the next crisis, which is going to just cause another headache where they have to then, lower interest rates. So this is one of the biggest things that I've ranted and raved about the Federal Reserve for so long, is that they're creating issues down the line that will ultimately, create more crises. And this has been going on for ages with the Federal Reserve, where, you go back to the late 90s, early 2000s, and what they did after the dot-com bubble then created a housing bubble. And then, the housing bubble, they created, spent all this quantitative easing, which then created this bubble that we're in. And, it's a scary thing, to be honest, because I honestly look to protect myself and my family and everyone out there. But all we can do is the best we can do, and just, protect yourself. Gold and other assets, maybe not necessarily all in dollars.
I think one of the things you pointed out earlier is how, interest rates can't rise too much. I mean, if we look back at what happened in the 70s, and people are kind of having the 70s, saying the 70s are kind of a parallel to what we're seeing now with inflation. If we do see that kind of inflation, I mean, Paul Volcker, the Fed chair, had a pretty aggressive stance back in, raising interest rates very, very high. I mean, it seems unlikely that would happen today. So it's like, how is the Fed going to control inflation?
Yeah, and you're 100% right on that. There's no way the Fed can. So if they raise interest rates, let's say to 8 or 10%, the country would go bankrupt in a matter of months, probably, or maybe years. But that it's impossible for them to do that. So the question is, what other tools in their tool belt will they have to deal with future crises? I worry that, they might artificially try to push interest rates into negative territory. So if you look at every crisis we've had, interest rates get dropped and then they come back up a little bit, and then the next crisis hits and they go even lower, and then it comes up a little. And then, so it seems like we're on that direction. But the question is, how low can they put it where countries are still going to lend us money? Right. I mean, if you see someone, think about a credit card company, you spend hundreds of thousands of dollars on credit card, they're going to eventually cut you off and they're going to say you can never repay. Other countries are likely to do that. Now, we are the biggest, the most powerful in the world. So countries will extend us credit for a long time to come. But there will be a point where they say, hey, the U.S. will never repay us. We're not going to give them any of our money. So you're 100% right like that. And it's a scary situation.
And with respect to gold, I know you are short-term bearish on silver, but long-term bullish. Where do you believe that gold stands right now?
So what I love about gold right now is that you had this big drop in the last week or two. It coincided inversely with the big move up in Bitcoin. So it seemed to me that there were investors in gold that had been in gold because Bitcoin had dropped out. And they were like, oh my goodness, Bitcoin's breaking out here. So we've got to sell our gold and buy Bitcoin. Now, what I liked about gold is that it was only a very short-term sell-off, and then it seems like institutions have come back in very quickly and bought that discount in gold back up. So I would guess that for the most part, gold is going to head higher. You'll have pullbacks. I have an inverse head and shoulders on gold on the GLD. And if it breaks the neckline of that, you have a GLD target price of about 205 or so, which would make a new all-time high on the GLD there. So there's some really bullish things. And it's not to say that on a day-to-day basis, you're not going to have interest rates going up and gold selling off. But as we learn that inflation is not transitory, you are going to see even a rise in interest rates being a good thing for gold. Gold will not necessarily sell off. So that's one point I want to make is that when you have interest rates going up because we get a good jobs number, gold will sell off. All right, that's been the way it's been for 20 years. A lot of people say, rising interest rates are bad for gold. That's only because we haven't seen what's happened with high inflation, because we haven't had high inflation. If you look at the 70s to 80s, gold went from about $100 in the early 70s to a high of $800 in the mid to late 70s, early 80s. All right. That was a huge percentage move, and that coincided with massive inflation and high interest rates. So the idea is that in this scenario, if we do get runaway inflation, gold should actually do really, really well.
Now, with respect to Bitcoin, we have seen a rally back about 50% of what it lost. It was at 60,000 back to 30,000, now at about 45,000.
So basically you have Bitcoin. It was trading in a range of 30,000 to 41,000. So it had been in a long consolidation kind of base. It then finally confirmed above 41,000, which enabled it to kind of have a short-term breakout. You saw that money flow from gold into Bitcoin, and we now find ourselves around 46,000 or so. Now, the key here is that as we move up, there's going to be a major resistance at around 50 to 52.5. So I like the idea here that you're going to top out right around there. So I think you still have a few more, 4,000, 6,000 more upside in Bitcoin from this 46,000 level. But I do think once you get there, you will have another level to the downside that actually takes you back to 41,000, which is going to be support, then 30,000, and eventually 18 to 20,000. Now, I always say this because people, there's so many Bitcoin crazies out there that they're going to be like, oh, he's so big. Long term, I love Bitcoin. All right, 500,000, 100,000, then 500,000 longer term. But you just have to understand the way deleveraging works. So there is so much leverage in the system. If you look at the margin numbers, and I'm talking in stocks and commodities and crypto, there is so much leverage that inevitably when the stock market collapses 5 or 10%, it's going to create margin calls in other assets like crypto, and it's going to take crypto down as well. So look for that flush out. I will be a huge buyer sub 20,000. And again, you might disagree that it's going to go there. I think it will during this deleveraging period, and that is exactly where I see it going. Now, one other little tidbit here. If you look, so everyone always says, oh, this is different, this is a different period. Well, if you actually look at 2013, when Bitcoin had a major bull run, much like we've seen over the last year, it ran up. It then had a huge correction, and then it had a huge bounce almost back to those highs before collapsing. The same thing happened in 2017. So these kind of bear bounces are huge, but they don't end well. And you have to have one more flush out. So I'm a big believer short-term Bitcoin might have a little bit more upside, but inevitably it should go down again, sub 20,000 before it really bottoms out.
That's such a good point because, if you do look at the chart and you see these corrections in the past, this 50% correction is actually pretty small compared to the ones we've seen earlier. So it doesn't seem like it's done yet.
No, yeah, you're 100% right. I mean, it's never that simple with almost any chart I've ever traded. And especially if you look at the history of Bitcoin. And again, people telling me, well, it's different this time and all this. And maybe it is. But as a trader, right, we base all our decisions off probabilities. So, we're not going to be right all the time, but the goal is to have a probability that's 70% or 80%. And if we can do that, then we're a rock star in our business. If you can win that many times out of every 100 times or so. So I think that's the point, is that you don't necessarily know, nothing is written in stone, but it's what has it done historically. And then you have to go and say, okay, well, if historically it's had these type of moves in a correction, what's to tell me that it's different this time? And again, it could be, but we don't know that until it proves it to us.
No, last time we had you on, you were talking about the stock market and how it looked like, in your opinion, it was hanging on by a thread. And really since then, it's been about 3 weeks or so. We continue to see all-time highs in the stock market. When do you anticipate this 5 to 10% correction that you've been talking about?
Yeah, so that's a great point. Is we've been kind of seeing this market that it's kind of been just slowly kind of going sideways to up on very light August volume, and we haven't seen that breakdown yet. Now I will reveal that I have a cycle this week, so a lot of people are like, oh, the cycle calculations are kind of crazy, but believe it or not, almost every past pullback in the market has been tied to one of my cycles. And we do have one this week that's on Thursday. The opening window starts basically today. So a window means that anytime within that cycle window, you look for a corrective move to start. Now, a corrective move for me would be significant volume. So on the SPY, which is the S&P tracking ETF, I want 70 plus million shares. And I basically want a drop of about 0.75% to 1%. And that tells me that it's not just a kind of a dead volume, non-event day. Now, today could be that. We don't know yet. It's not the end of the day. But I will be monitoring the volume and the price action. Now, if you get that, it could signal the start of it. One of the things I'll be looking for in the coming days, should we get that today, is what we would call confirmation of that corrective move. And that would require a secondary lower close on decent volume. So for instance, let's say on the S&P, we close at, 3,540, right, which is where we are. Check that. I'm talking about the Dow there. So the S&P would, let's say we're right now at 4,453. So if we closed right here, we'd want to see a significant sell-off in the next couple of days to confirm that move. I'm looking for it. I still believe it's coming here. I think that the light volume has been kind of something that the August period is very normal, and has kept the market to the upside and kind of just floating. But I do think it starts sooner than we think. And I do worry that it could be nastier than anyone thinks. So be on alert, essentially. I remain short the NASDAQ. I remain short the S&P. I do have longs out there like Viacom. I'm long Viacom based on valuation. I think that in a big downward move, higher paying dividend stocks will do a little bit better. So I do have some exposure on the long side to stocks like that. But for the most part, I can't buy valuations up here. They are historically insane. People say, and this is another interesting point, people say that during high inflation periods, stocks should do better. But again, if you go back to the mid 70s to mid 80s when inflation was rampant, you actually had PE ratios for the S&P that averaged under 10. Now, put that in perspective to the PE ratio, which is for the S&P, I think it's north of just 20 right now. So it's not true. There's a lot of kind of misinformation out there that if you actually look at the numbers historically, they don't mesh with what's being said. So just be aware of that. You get high inflation, you get the markets to actually correct and valuations to come down significantly.
What kind of correction are you anticipating? I know you've talked about maybe a 10% correction. You're saying, though, it could be a bit nastier than people are expecting, though.
Yeah, so I mean, to be honest, I think people are expecting like 3 to 5% because the last 6 pullbacks on the S&P have been about 3%. That's it. And what's so crazy about it is that investors have been conditioned to feel when we pull back 3% over like 2 or 3 days, people are like, oh my goodness, this is such a big move. Historically, it's not. I mean, it's not a big move at all, but we just haven't experienced a big pullback. So, I'm always hesitant to make a specific corrective move call because, it'll go like, let's say I say 10, it goes 8, and everyone's like, oh, he was wrong, right? But bottom line is that I think that the market and investors will buy the dip at 3%. I think it probably at least does 10. There will be an issue down the line where we see another 60, 70% correction. Well, crash, essentially, much like we saw in 2008 and 2009, just because of what's gone on in the system. There's so much kind of dead flesh in the system right now, to use kind of a morbid, phrase. But at some point, you have to wash out all of this nonsense that the Fed has done and kind of do a reset, which you could arguably say was attempted in 2008, 2009 with the markets, but never really got allowed to happen because of the Federal Reserve intervention.
Right. I mean, even if you look at like the S&P right now or the Dow, even if you had a 10% correction, for the S&P, you'd be up 10% on the year. You'd still be up 17% for the Dow on the year. So it's just like, that is really nothing. Longer term, it does seem like, we might be overdue for a more significant 2008 style correction.
Yeah. And that's the one that, it's so hard as a swing trader, because we're so used to these corrections where if we drop 5%, it's like, okay, take some money off the table on the shorts, but you really want to let those run, or you want to buy, longer dated put options where you can just make so much money. But again, the timing is so tricky on it, where you don't know if is it going to start in the next couple of weeks? Is it going to be months? Is it potentially going to be years? And the trickiest thing is that because of Federal Reserve intervention, arguably this has been the longest bull cycle we have ever experienced in history in the markets, because the Federal Reserve has been pumping these drugs, essentially money, into the system. So it just creates, as a market timer, it makes it so hard to time when you have kind of, it's like playing Monopoly or some other game with someone, and then all they do is like, you're like, oh, I'm going to win, they're almost out of money, and then they just reach over and grab more money out of the thing, and it's like, well, what the heck, when am I ever going to win this game if they have unlimited supplies? So we'll see how it goes here, but inevitably I do want traders and investors on edge. Even if you're long, just be fully aware that there's a lot of fat in the system and it's going to have to be washed out.
All right. Well, Gareth Soloway, we really appreciate your insights today. Before we let you go, did you want to share with the viewers where people can find you and any last thoughts you'd like to add?
Oh, that's nice. Thank you so much. Yeah, follow me on Twitter at Gareth Soloway. So just at my first and last name. That's the best way to find me and kind of follow. I posted up some really interesting tidbits today for free. It's all free on Twitter, obviously. And you can always come to inthemoneystocks.com as well. And then the only thing I just leave you with is it doesn't mean to be out of longs. I want to be clear on that. The Fed can kind of grind this market out, but be aware that we're starting to see things occurring in the system that are scary, meaning that, if you look at the semiconductors, they've started to lag the overall market. Early this morning, even though the NASDAQ ended up falling, the NASDAQ was up. The NASDAQ 100 was up only because you had Apple, Google, Microsoft, and Facebook up. It was 4 stocks that were basically keeping the NASDAQ from having a big drop. Now, they reversed, but you just have to be aware that the internals of the market are not good. We've seen the 52-week lows outpace the 52-week highs for the last month or two by a sizable margin. And what that's telling you is that the internals continue to weaken, even if there are 1 or 2 or 3 or 4 stocks that are keeping the indices higher. Oil started to collapse. That's generally not a good thing as well for the economy. Even though people want lower oil prices for gas, it also tells you that you're starting to see potentially a slower consumer, and that could be due to the Delta variant. But just some concerning things out there, and I just do want people to be on alert.
All right. Well, the website is inthemoneystocks.com. Gareth, once again, thank you so much for your time, and God bless.
Thank you so much, Elijah. I appreciate it.
This week's specials with Miles Franklin Precious Metal Investments. 1 ounce 2021 Silver Britannias for only $3.75 over spot. 2021 Silver Austrian Philharmonics for only $3.95 over spot. And 2021 Silver Australian Kangaroos for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.